or relative strength index is one of the most popular trading indicators. And we're going to refer to it tonight mostly by RSI, which is short for relative strength index. Now, the relative strength index is a momentum indicator developed by a technical analyst named Wells Wilder. Sounds like some movie star name. And was published in his book, New Concepts in Technical Trading Systems, in 1978. That was what, 30, 40 years ago. So this is a well-established indicator. But of course, if you think back in 1978, there was no online trading. There was no computerized charts and computerized technical analysis, and everything was done by hand. And the market consists primarily of professional traders and brokers. So you know if this indicator has survived all that, it must be a very reliable indicator. And it is one of the most widely used indicators. So without going into the deep innermost parts of the workings of RSI, it is primarily used to attempt to identify overbought and oversold conditions when trading an instrument. Now, over the years, RSI has been tested in Forex trading, CFD trading, in commodities trading, future trading, option trading, ETFs, all the new markets that have opened up, and has been found to be reliable whether you're trading gold or trading the euro, whether you're trading long-term or investing long-term or trading short-term. So let's talk about this oscillator. And RSI falls into a class of oscillators known as bounded oscillators, because the value will always come out between 0 and 100. So it's bounded within that range. Now, an oscillator is a technical analysis tool we as traders use to give us the indication of whether an instrument is oversold or overbought. Now, we use these overbought and oversold extremes to see which direction the price action will have momentum. Oscillators are typically used in conjunction with other technical analysis indicators to make trading decisions for entering trades. There are a few oscillators like RSI, ROC, MFI, and that do the same, but this is the one we're going to discuss, and it is the most popular. Now, one must fully understand overbought and oversold. When a market becomes overbought, means it's too many buyers in the market. It doesn't mean it's necessarily going to fall at that moment. An overbought market can remain overbought. What it is telling us, though, is that the momentum is dying down, because it takes a lot of buying to keep pushing an asset up, 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 up. And when the momentum dies down, it's because the price has gotten too high or the market's gotten overbought, and eventually it will come down. Just imagine, you shoot a rocket up into the sky, it's going to continue to fly up, 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 but there's a point where its momentum or its velocity will start to slow down. Now, it can continue going up, but as that velocity or momentum slows down, it's going to eventually flip back down. So traditionally, and according to Wilder, RSI is considered overbought when the calculation comes in above 70 and oversold when it's below 30. Now, signals can be generated by looking for divergence, failure swings, and centerline crosses. RSI can also be used to identify the general trend. So before we talk about the calculation, let's go look at a chart and see what RSI looks like on a chart. So let me pop up. So now we're just looking at the current Euro US dollar chart for a 30-minute time frame. And by simply clicking on the indicator button Actually, I'm going to take RSI off of here. And by simply going up to the indicators and, whichever charting system you're using, you'll find it the same way. Just find out where they have indicators and then locate RSI. So we're going to scroll down here to relative strength index, and we're just going to pop it on there. And we can see it's now dropped on the bottom of our charts. RSI is placed underneath the price chart, not on the price chart. We can see that there is an area filled in here. Okay. We look over here, we can see a 50 line, we can see a 100 line, and we can see a 0 line. We see 10, 20, 30, 40, 50, 60, 70, so forth. This zone in here between the 30 and the 70 right here is, let's say, for the lack of a better word, say dead man zone. Doesn't help us at all with anything when we're looking at RSI in the general principles. So we can consider this a zone that's unimportant. But there are some people who look at crosses of when the RSI is going above or below the 50 mark. Because there are some strategies that use this 50 mark as simply as an indicator of where the asset is going or which direction it's starting to move, where the momentum is. And as we can see, when price is moving up, the indicator, the RSI, is moving upward. It doesn't move exactly with the trend because it's a completely separate calculation. But while it is between the 0, the 70, and the 30, is very little interpretation. We're looking for breakouts when it breaks below 30, or we haven't had any recently, when it breaks above the 70. There's also some very important interpretations they can use when it's moving in an upward fashion and approaches that 70 line, is unable to break it, and then falls off of it. Because that means it's not moving into overbought conditions. But there's different strategies and interpretation. But first, let's figure out how it's calculated and put on the chart, and then we're going to talk about how you might want to use it. So let's go back to my PowerPoint. Okay. Now, RSI is a relatively easy mathematical calculation, although you'll never, ever have to do it. Okay. RSI is equal to 100, simple 100 number, minus 100 divided by 1 plus RS. RS stands for the average number of days when the instrument closed up or closed down. Okay. Now, that's a kind of what is RS? Okay. RSI takes in a period of 14 days or 14 periods. Okay. So if you're looking at a half-hour chart, it's using 14 bars on that chart or 14 half hours. We're looking at a daily chart, we're looking at 14 days. So to simplify the calculation explanation, RSI has been broken down into its basic components. RS is the average gain and the average loss. The RSI calculation is based on 14 periods, which is the default suggested by Wilder. The very first calculation of the average gain and average loss are simple 14 period averages. Okay, no different. The first average gain is equal to the sum of the gains over the past 14 periods. So you're only adding together the days or the periods that the asset moved higher, and you're averaging the gains together and then dividing by 14. The first average loss is equal to the sum over the past 14 days divided by 14. So if you had all down days, you might end up with 14 down additions. So if it fell 5 points one day, 2 points the next day, 3 points the next day, or the next period. Okay. But this gives us RS. But after the first one, and this gets a little bit weird, but after the first, or it gets a little involved to do this, but it's common sense. The second time we calculate RSI is based on the prior number less the next 13 periods of gains. So it's still giving you 14. But you have the average gain and the average loss over the last 14 periods. Now, taking the prior value plus the current value is a smoothing technique similar to that used in calculating an exponential moving average. This also means that RSI value becomes more accurate as the calculation period extends. Advanced charts use at least 250 data points prior to the starting date of any chart. Well, since you're not starting out a chart, and since you're not starting out the calculation, and you're just dropping RSI on the chart, you don't have to worry about how many data points it's using because you're not starting anywhere. So when you drop RSI in, it's already taken all the data, moved it forward, added the last one to the next 13 gains and losses, and you have an accurate representation. And it really doesn't matter where you're calculating RSI. So Wilder's formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. And in fact, a plot of RS looks exactly the same as RSI. Because the RS is, remember, it's 100 divided by 1 plus the RS. Okay. And it's actually 100 minus 100 divided by the RS. Now, the normalization step makes it easier to identify extremes because RSI is range bound. RSI is 0 when the average gains equal 0. Assuming that the 14 period RSI, a 0 RSI value means that prices move lower in all 14 periods because you got no gains. There are no gains to measure. So RSI is 100 when the average loss equals 0. This means that prices moved higher in all 14 periods and there was no losses to measure. So the default look back period for RSI is 14. Okay. And now I'll mention this, but none of us should be using it. But this can be lowered to increase sensitivity or raised to decrease sensitivity. 10-day RSI is more likely to reach overbought or oversold levels than a 20-day RSI or 20 period. Now, you will find a lot of market gurus preaching their own strategy of how to adjust RSI, and they'll adjust stochastics, they'll adjust any indicator, and they'll say, do this, do this, do this, and combine them together, and you'll have a perfect trade all the time. Doesn't work that way. I, in 99% of the cases, always stick to the golden rule, and that's based on the man who developed the indicator and what the developed recommendations are. Now, RSI is considered overbought when above 70 and oversold when below 30. Now, please, these are general guidelines and need to be interpreted a little bit loosely. 30 and 70 are the ranges above and below that we look for overbought and oversold conditions. But 68 and 65 could be magic numbers. Okay. Just like 80 could be more important, because what you have to do is you cannot stick to this golden rule. It is an advisory. You have to look at historically how the asset or the market you're looking at is also traded. There are some stocks okay, that move relatively slowly, and they can be steadily moving up and moving overbought, but because they move at a certain slow distance, they don't actually calculate into this overbought condition. And they tend to find that they are overbought when they hit 67 or 68. So you need to look historically back to see how an asset moves, because maybe 69 is more important for that asset than 70. Now, for Forex, 70 and 30 is a good indicator. Now, since RSI measures the relative strength of the underlying market, it is a technical tool that can be applied to nearly any market. However, it is commonly applied to more liquid and larger markets like Forex, stocks, and commodities. RSI also happens to be a very good indicator for cryptocurrency. But because cryptocurrency is so volatile and moves so quickly, that we have to find new parameters. Because in cryptocurrency, we can see Bitcoin jumping up and down hundreds of dollars in a day with huge volatility. Okay. So we need to find more specific levels. So once we've identified those levels, RSI will work pretty well. Now, in a downtrend, RSI can remain oversold. Okay. Use the center line to determine market direction. Remember when I showed you the 50 line? That 50 line is very important because that center line can help us develop market direction. So when the asset breaks above 50, when the RSI breaks above 50, moving towards 70 or higher, regardless of what number it is, when it breaks above that 50 zone, that is telling us that that market, and it should be matching the market, that market is beginning or moving in an uptrend. When it's above 50 and falling below, it should be telling us that asset is starting to move or in a downtrend. So it will help us identify trend direction. So when selecting the indicator and chart, you will be prompted to change the parameters of RSI. I would suggest that new traders keep it at the default setting of 14 and the RSI values at 30 and 70. So let's go back to a chart again. And we can at any time go here to our format, and we can then go into our inputs and see we can change the length of the input from 14 period, and we can change it to whatever we want. We can also tell it to take the open, the high, the low, the medium, the close. Hold on, guys. I don't know what happened here. I'm trying to fix it. Ladies and gentlemen, I don't know what happened. Their system just crashed. Hopefully, you're all still in the audience. I didn't lose you. I got everything back up on the screens now. I'm just going to type in. If you look, I'm sending you a message. If you just respond to that chat message, if you have the ability, and let me know that you can see and hear me. And I don't know if you got kicked out, if you got lost, if you're all there. So I'm going to continue on here. So let me see if I can get that chart back up here without having any problems. Okay. All right. So back again, we were looking at the chart, and we have the 70 and the 30 level, and we can look and keep our eye open on the 50 level. Right here. And we always want to be aware of when the asset is crossing down and below 50, or when it's crossing above and out of 50. And it should be moving along with the trend. Okay, so let's go back to the PowerPoint. I'm just hoping I don't lose you again. Okay. So you will also see the RSI value of 70 and 30 across your indicator. If the RSI moves above 70, this is an indication that the instrument is overbought and is set for a trend reversal in price action. The opposite applies when RSI crosses below the 30 parameter. When these trend reversals happen, we want to get into the market and ride the trend as long as possible, and preferably until the next trend reversal happens. So what we want to look for is, here we can see RSI fell below 30, and this is the price of gold. And again, it predicted when the market was overbought here and the market turned and moved into a upward trend or an uptrend. Now, we might use other indicators to help make it an entry point or a trading decision. But if we were using the 50 line, this is somewhere about the point where we could have, I'm sorry, I can't draw a straight line here, that we would have considered entering the market. So if we waited until it got to 50 levels right here, we would have still gotten a very, very nice trade in. Here, the markets came down. Now, if you notice, in gold, it never broke above the 70 level, even though the markets did reverse. It came up to the 70 level, but wasn't able to violate it. Moved back down, broke the 50 line, and at the breaking the 50 line is when we want to see that this trend is about to end, and we're looking for some odd stuff here. It comes down, and here again, it violates that 30 to get to the 29 range, but that's about it, and then turns around and moves back up. And when it broke that 50, we might have been thinking about getting involved in the markets. Here again, and here again. So as you can see, it's very accurate at predicting when the markets will reverse action. Okay, it doesn't tell you exactly when, it's telling you when it's lost the momentum. So again, imagine a rocket going up into the sky and you're just watching it go up, 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 and it's sailing as far as you can go. It's hard for you to see the momentum and the velocity slow down. But if you had an indicator down here all the way on the ground saying, uh-oh, it's starting to lose momentum, it's starting to lose volatility, you would then start to wait for it to see it tip over and start coming back down. And this is what this indicator is telling you above the 30 and below the 70, or above the 70 and below the 30. Now, there are many different ways that we can trade with RSI. So RSI is used in a number of ways. Three of the most popular functions are overbought and oversold. Okay. We've been looking at that all night, 30, 70. Okay. Then we have RSI ranges and RSI divergences. Okay. Now, a lot of times you'll hear in the headlines and news and stuff, the stock is overbought or WYZ is oversold. Often the speaker is referring to the stock's RSI reading. When the RSI is above 70, it shows a strong run in higher in prices, which may not be sustainable and therefore due for a correction. This is overbought and oversold, what we're talking about. When the indicator is below 30, we've got the opposite. Unfortunately, it's not as easy as buying when the indicator moves above 30, below 30, and above 70. Some confirmation of a change of direction is needed. So let me pop up a couple live charts and let's see how we did some analysis on these charts to show you how you might want to use RSI. So here we have a very interesting scenario. We actually have bearish divergence in the indicator. What we see is, remember I mentioned one of the three ways to use it: overbought and oversold, range trading, and divergence. What we see is that the indicator is moving in a downtrend. Okay, it is making lower highs as it's moving across, while price is moving in an uptrend. We have a divergence. That divergence is very, very important because when we get a bearish signal or an overbought signal in a divergence move, it's going to tell us that trend is really over because we've had that whole momentum diverging in this whole entire range. Or if we had the bearish and it broke the 50 range. Okay, so whenever we see, and we can see that we very obviously see the difference between the trend of the markets and the trend of the indicator, the trend of the RSI. Okay, here, I don't even know what I have here. I have a mess here. Here you have RSI bouncing all over the place. Okay, and this is telling us, or this is more like range trading. The asset is staying contained within the 30 to 70, but extremely volatile and moving all over the place. Okay. And what is really telling us, even though we see a downtrend here in price, okay, it's giving us a warning that there is no tradable entry point from this downtrend. Okay, that's RSI. There's other means to trade it, but it's telling you that the indicator is way out of whack. It's way stuck in this weird wild range while the asset is moving through a downtrend. But it's not showing enough momentum, or it's not giving you enough velocity predictions to actually decide to make a trade. So let's go back to the PowerPoint. Let's discuss this or come up with some other examples. So we want to allow the price to cross below 30 and then rally back above it before buying. So remember, this is an important point. When the price falls below the 30 level and then reverses and rallies back into that, above that 30 level, so back into that purple range that we were showing you, that is giving you a clear buying opportunity. Or we can let the price cross above 70, and then when it comes back below it, before selling. So we can see on this chart of Apple, we can see divergence, as RSI in this case moves back to the overbought level. We have RSI crosses above 50. Okay, these are all the important levels we want to talk about. Here we have divergence and an oversold level. Okay, so there's many times we want to look at that, and here we can combine this divergence and see prices moving down while the indicator is moving up. Okay. So this approach can work well in range trading markets when the price is swinging back and forth between overbought and oversold levels. So the price may not always reach 30 or 70 if the stock doesn't quite reach the predefined levels. Alternative levels could be such as 65 and 35. When a buy is triggered, a stop should be placed below the recent swing low. A sell signal is used to exit long trades or initiate short trades with a stop above the recent swing high. During trends, the RSI will usually stay contained within certain readings. During an uptrend, its typical bottoms above 30 and frequently reaches 80 plus. During downtrends, the indicator will typically top out before 70 and frequently reach below 20. This can be used to confirm trends and provide entry signals during a trend. During an uptrend, buy if the price drops below 35 and then rallies back above it. Place a stop loss below the recent low. Sell when the price moves above 70 and then drops back below it. So what you want to do is you want to wait for price to break that level and then ease back down into the safety zone. Okay. One problem with this strategy is RSI might not provide an exit signal, in which case a winning trade may turn into a loser. So for such occasions, having a price target or another exit method is needed. And this is because the rule of thumb is never trade with a single indicator. You should have other confirmation tools. Now, you always need to be able to place your take profit level, your stop loss level, and need to confirm them. So if you sat back and just waited for RSI to give you an exit signal, and because the market changed and was about to reverse but didn't break that 70 or 30, so and you didn't exit the market, you could have lost your position. So you should always calculate your stop loss take profit levels before and not after the fact, because each stock or asset moves differently and therefore may have slightly different ranges. During a downtrend, short sell if the price rallies above 65 and then drops back below. Place a stop above the recent high. Cover a short position when the stock drops below 30 and rallies back above it. Now, RSI is also used to spot divergence. We've talked about divergence a couple times already. Bearish divergence is when the price is rising, but RSI is falling. It warns that the price could soon correct lower since buying momentum is slowing. Divergence is not a timing signal, as it can last a long time. Rather, divergence helps confirm other signals and lets traders know when the trend is over or almost over. Bullish divergence is when the price is falling, but the RSI is rising. It warns the price could soon move higher since selling momentum is slowing. Now, the RSI has several limitations, as all indicators do. Since the indicator is showing momentum, as long as momentum remains strong, the indicator can stay in overbought and oversold territories a long time. Therefore, a price analysis or some other confirmation tool is needed to confirm reversals. The same is true of divergence. While the RSI may be dropping and price rising, that doesn't mean price will drop soon. The RSI is just showing that the price is moving higher at a slower pace. So it's important to look at the quality of the trend and the intensity of a trend. Again, if you fired a rocket straight up into the air and you were looking for it to turn over and fall, that would be different than if you fired a rocket off on a long-term angle and it was going at great momentum on this angle, this lower angle, and then lost momentum and it fell. It's two different viewpoints, and you have to be aware of how this trend is. What is the speed and the velocity and the intensity of the trend we're looking at? RSI ranges can help confirm trends, but each stock or market will have slightly different levels. One stock may repeatedly move to 38 on pullbacks, while another might only go to 33. Therefore, some adjustment is often needed for each stock, since one size fits all approach may not work. The most basic RSI application is to use it to identify areas that have potentially overbought and oversold. The level of 50 represents neutral market momentum and corresponds with the center line in like other oscillators such as MACD. In terms of market analysis and trading signals, RSI moving above the horizontal 30 reference level is viewed as a bullish indicator, while RSI moving below the horizontal 70 reference level is seen as a bearish indicator. As with other momentum oscillators, overbought and oversold readings for RSI work best when the price is moving within a sideways range rather than trending up or down. Now, Wilder suggests that divergence between the asset's price movement and the RSI oscillator can signal a potential reversal. The reasoning is that in these instances, directional momentum does not confirm price. A bullish divergence forms when the underlying asset makes a lower low and RSI makes a higher low. RSI diverges from the bearish price action in that it shows strengthening momentum, indicating a potential upward reversal in price. Now, failure swings is the last of these examples we're going to talk about. And a failure swing is a very important thing. Remember when I was telling you if price got to the 70 level but wasn't able to break above it, or down to the 30 level but couldn't break through it? Wilder outlines another important indicator of potential price reversal called failure swings. A bullish failure swing forms when RSI moves below 30, rises back above 30, and pulls back again, but holds above the 30 level. The failure swing is complete when the RSI breaks its recent high. This breakout is interpreted as a bullish signal. A bearish failure signal forms when RSI moves above 70, pulls back below the 70, rises again, but holds below 70. So in other words, it breaks above the 70 level, falls back below, and reverses and comes back up, but it can't break above that 70. This failure swing is complete when RSI breaks its recent low. This breakout is interpreted as a bearish signal. Trend lines can be used on the RSI oscillator itself in the same way as price charts, by connecting higher highs or higher lows in an uptrend or lower highs in a downtrend. Breakouts above and below these trend lines can serve as indicators of a potential price reversal. When traders first learned about RSI and other oscillators, they tend to gravitate towards the overbought and oversold values. While these are intuitive points to enter the market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and this means extended trends can keep RSI overbought or oversold for long periods of time. So keep the eye also at all times on the center line, the 50 line. watch the center because it tells you something about the momentum of the trend and where the trend should be moving. Now, the bottom line is RSI is popular because it has multiple uses. It is used to find entry and exit points based on overbought and oversold readings and trending markets. It can help spot or confirm reversals via divergence. Like any other technical analysis tool, though, RSI is prone to providing false signals. Price analysis is still needed to determine if the trend is present, and then important RSI levels identified for that particular security, and always combined with other indicators. So don't follow the 30-70 rule blindly, but learning how to use RSI and its nuances can help you make good trading decisions. So on that note, I'm going to say goodnight to everybody. Thank you very, very much for joining us, and we'll talk to you again real soon. Have a good night now.